Hello there, everyone. This is Mitch Goldberg. We are live. I'd like to welcome you to another episode of Be the Boss of Your Money, because I want you to be the boss of your money, not the money, not your money, to be the boss of you. Today's value proposition is dividend ETFs, investing in dividend exchange traded funds. It's a huge topic. We're seeing a lot of dividend cuts this year, and people are being affected. Some people, though, are doing a lot better than others when it comes to investing in dividends. What's the secret? I'm going to tell you now, and we're going to jump into the video. First, we'll roll the intro. Hey there. Thank you so much for joining me today. If we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor. I'm with a wealth management firm called Client First Strategy. What we do here is we work with personal investors day in and day out. It's what we do. Today's topic is pretty important, so I'm dedicating the entire show today to one topic, and that's investing in dividend ETFs. Because when it comes to investing in dividends, I would say that the pretty good majority of clients today of mine invest using dividend exchange traded funds when they want a specific dividend portfolio. So we need to talk about this, and we need to also warn people of some of the issues that are taking place in the industry right now. So I would welcome you, and I want you to, I would love this. Please feel free to ask questions in the comments. I would be delighted to answer them during the live presentation. And if you're out there in Facebook or LinkedIn, I will be checking for both. So your questions are welcome. If you're watching this in the replay, I'd like to welcome you as well. Certainly feel free to ask questions in the comments during the replay as if you're watching in the live presentation. I will see those questions. I will get back to you. And again, I'd be happy to answer your questions that you have. So let's first start with talking about what exactly are dividends. So we're talking about exchange traded funds, dividend ETFs in particular. It's something we need to know a lot more of because so many people are invested in dividend stocks or dividend type products like mutual funds and exchange traded funds. But today we're talking about exchange traded funds. That is my choice of the type of investment vehicle that I use for my clients. I pretty much have stopped using mutual funds many, many years ago. So let's talk about this. A dividend is paid. By the way, we're going to stick with common stock investing, not other kinds of investments that pay dividends. So a common stock of, let's say, Apple or McDonald's or Costco or Johnson & Johnson or Procter & Gamble, they pay a dividend. What that means is when they make a certain amount, when they make a profit, after they've paid everybody in the company, they've paid their expenses, they've got a profit. There's three things that they could do with that profit. They can save that money for a rainy day, like if we go into a recession or a pandemic-induced recession. Okay, it's a good idea to have a lot of extra cash on the balance sheet in the bank. They could reinvest that cash in refurbishing their business, updating stores, updating technology, updating their website, updating distribution. They could do all those things. And they could also pay a dividend and send some of that money out to the shareholders. There's a fourth thing that they could do. They could also do stock buybacks. So stock buybacks basically means when a company has extra money, they don't pay it out as a dividend. They don't use that money for reinvesting back into their business, nor do they save it for any day. They just go out into the open market and they buy shares of their stock in the market to reduce the share size. This has the effect of hopefully taking some shares off the market. If you have more shares on the market and the demand rate remains the same for the shares, that could elevate the price of the shares. We've seen a lot of companies get into trouble, like airlines who spent many billions of dollars on stock buybacks. Now we go into a pandemic, nobody's flying, and all of a sudden these companies now have their hand out for a government bailout. That's the problem with buybacks. It's not really my choice of value creation. The dividends, though, I think all companies, good companies, will typically pay a dividend, will reinvest in their business, and keep some cash on the sideline for a rainy day. The kinds of companies that pay dividends are usually larger, established companies, not startups. And the reason I say that is because you take a startup company, let's say an Uber or a Beyond Meat, those kinds of companies, they're investing every penny they could back into the company for growth. They want to invest back into growing their business. So typically, growth companies, newer companies, are less likely. You'll be less likely to find those companies paying a dividend. So you're probably not going to find. Well, if they don't pay a dividend, you're not going to find them in a dividend-paying ETF. But generally speaking, I want you to get an idea of who's paying a dividend, who's not paying a dividend, and how big a dividend could be. So the next thing is that companies, when they pay a dividend, they usually pay a dividend when they're confident about the future and they don't think they're going to need that dividend money that they're sending to shareholders. They think that, they don't think they'll need it. They can send it out to shareholders, keep their shareholders happy. It's considered a nice reward for your shareholders. So let's say you buy a stock, it's $100 a share, and it pays $3 a share in dividends. 3 into 100 is 3%. Now, that might not sound like a lot, but the average dividend for the S&P 500 is less than 2%. So 3% payout. They don't sound like a lot, but they do add up. There's a few things you can do with the dividend. Number one, you could take the money, let it accumulate, and use that to buy a new security, a new stock. You could reinvest that money automatically and buy more shares. So let's say you own Johnson & Johnson and they pay a dividend. Every quarter you get that dividend, you could just basically say to Johnson & Johnson, you know what? I don't want the cash. Just buy more shares of Johnson & Johnson stock every quarter. That's reinvesting, and that's a form of compounding. And then you could also just take the money out and use it for spending money. And this is where people get into really thinking about dividends, because dividends are a form of passive income. So let's say, for example, you go to your job, you work hard, you earn an income. That's your active income because you are actively pursuing that income. When it's passive income, you're not really doing anything except for owning the stock. So the dividend just comes to you automatically. You're not really doing anything in terms of active employment, active pursuit of that income. So I realize a lot of you may already know this, but I'm not sure what everybody knows who's watching this particular live presentation. So I want to make sure we start at the beginning, catch everybody up, and then we can move to the next phase. So I've got just a ton of notes. I know a lot about this stuff, but to try to actually regurgitate it all into just one lesson, it's like, wow, how do I tell everybody everything? And you don't want to leave anything out. So typically in a bull market and a strong economy, companies pay their dividends. They often raise their dividends, and you find more companies declaring a new dividend for the first time. And then what happens is you go into a recession, because it's always a cycle, and we go into recessions. And then companies get worried about their cash flow. They're making less money. Fewer customers are spending money in their products. Automobile companies are selling less cars. So companies decide they need to conserve cash, and a lot of them decide that they will either cut their dividend or eliminate the dividend, or suspend it altogether. Now, when that happens, that typically brings down the price of a stock, because companies don't suspend or cut a dividend when things are good. They do it when things are not so good, when things are bad, and they're in cash conservation mode. And in this environment, you're seeing a lot of companies heading toward bankruptcy or talking about going into bankruptcy. So you could see that it's a worry that when a company in this environment, especially now with such a severe recession/depression, over 30 million people have lost their jobs in the last 6.5 weeks or so. So when a company decides to cut their dividend, it does get investors worried. Plus, they're getting less dividend. They're getting less of a good thing. So they're less inclined to hold on to that stock. So people then sell that stock, puts more supply of that stock into the market without fewer buyers. So that means the stock will often, not every time, but usually goes down. So that's pretty much a negative right now when you see a company cut or suspend or reduce their dividend, because it signifies that they're in cash flow saving mode. And we want companies that have ample liquidity and cash to get through a tough environment. Okay. And or companies that sell a product that could do very well in this particular environment. So, and that's what happens. So when you go into recessions, all right. So if you take a look at a company like, let's say, Berkshire Hathaway, that's Warren Buffett's company, they get something like $670 million. Yes, about $640 million in dividends from owning Coca-Cola, like 70 some odd $1,000 per hour every hour from owning Coke. So you can see that dividends, when you do have a lot of money invested in the stock market, they add up. But don't think you shouldn't enjoy dividends because you don't have a lot of money in the stock market. Whether if you're investing in a 401k plan or just in an IRA or a Roth IRA, or just you're in an individual regular brokerage investment account, you could still enjoy dividends. You can reinvest the dividends. Everybody has to start somewhere. And I say starting small, AKA your first step, is the most important step that you could take on your path toward financial freedom over the long term and toward your retirement and becoming just overall better with your personal finance. So that's how dividends work. Now, the more shares, obviously, you have a stock that pays a dividend that you own, the more dividends you're going to collect, and vice versa. Now, as we said before, with the recession, a lot of companies have been cutting their dividends. I have a short list here of companies that have either cut or suspended their dividends. And the list includes a lot of names that you're probably familiar with, but Dick's Sporting Goods, Ford, Carnival, Marriott, Delta, Royal Dutch, Dunkin' Brands, Boeing. There are a lot more, but these are some of the names that you probably recognize. But you notice a lot of these companies are in travel, like Carnival, or selling cars, like Ford. So you could see that these are, the kind of problems that companies like airlines are having right now. So that's who's being affected. And you've seen the price of oil go down over 60% this year so far. Even with a rebound in the price of oil in the last like 4 or 5 days, oil is still down about 55 to 60% year to date. So so you're seeing a lot of travel, hospitality, travel and leisure, energy type companies reducing or cutting their dividends. And oil companies have always been known to have pretty high dividends. So it's a shame, and it's a pretty big loss of income for a lot of investors. Now, not all is lost. There are a few bright spots: Johnson & Johnson, Costco, and Procter & Gamble, just to name 3 companies that have actually raised their dividend. But those are really the diamonds in the rough. But for the most part, companies are cutting their dividends. So I'm just going to show you a quick picture here, okay, of what it looks like in terms of dividends that are getting cut. So I'm going to move a screen around, and I'm going to give you an example in a screen share, okay? So let's just put this up on the screen. Screen share. Take a look at this chart, okay? This here, I hope you could see this in your phone, but in the Great Recession, 2008, 2009, see, all right, if you take a look at those over there, maybe I can make this a little bigger. Is that better on your screen, guys? That's about as big as I can get it, okay, on your screen. A lot of you are probably watching this on a smartphone, but there were a lot of dividend cuts decreasing, S&P 500 companies decreasing or suspending dividends by year. So 2008, 2009 saw a huge jump. Now we're still very early in 2020. You see this over here. We're still very early, believe it or not, in this Great Recession. It only started really in the middle of February and accelerated through the end of April. Still going strong, unfortunately. We just don't know when it's going to end. It's very open-ended. We have a lot of things to keep an eye out for, but let's just focus on this. But you see companies cut their dividends. A number of companies are cutting their dividends. And a lot of companies raised their dividends between 2009 and 2020, but it took a long time. I mean, you could tell by looking at this, the bad stuff happens quickly and the good stuff takes a long time to recover. But the good news is after the Great Recession, it took a few years for dividends to make a strong recovery. But when they did, you saw the companies that were reinstituting the dividends and raising their dividends, those stocks did very, very well. So there was an opportunity in this. So I'm not saying that any company that cuts a dividend is automatically an opportunity to buy right now. That's not at all what I'm saying. But over the next few months, maybe the next year, as we wind our way through this recession and we start to have more visibility on the pandemic and getting the economy back on its feet, that's when we could take a look at companies whose cash flow has improved, who have reduced or suspended their dividend, and we can start to take a look at who's going to start increasing their dividend payouts. And that could be a substantial opportunity, just like it was over the last 10 years before this pandemic actually hit us. So that's a lot about dividends, and there's some opportunity there. So I want to just make sure that we understand some good ways to go into dividend investing. Now, if you're just looking for dividend paying stocks, then what I would feast your eyes on is take a look. This is a very popular dividend paying stock. It's not coming up on my screen yet. I'll refresh the page. It might take a moment. There we go. We're looking right now. These are numbers here for AT&T. The year high is $39. The year low is about $26. Okay, currently the stock is a little bit under $30 a share. This is just blank space, is just where the chart is. We don't really need that for now. But they're AT&T. I actually have this stuff memorized, so I'm going to quit the screen share right now. AT&T has a dividend about $2.04 per year. So it's about a 7% dividend yield, but they're only making, as of now, this is based on the past 4 quarters, $1.97. And so AT&T is not really making enough at this point to completely cover their dividend. AT&T also recently completed the acquisition of Time Warner, so they have just a massive, massive amount of debt. And in this kind of environment, when you see the economy slow down dramatically, this is when too much debt, or as we call it, too much leverage, and too big of a dividend become problematic. Because if AT&T decides that business is slower, they have too much debt to pay off, their interest expenses on their debt is very high, or is a lot. I'm not saying that their interest rates are very high, but the amount that they have to pay is a lot. So they might actually look to cutting their dividend a little and say, well, right now it's just about a 6.7% dividend yield. If we cut that dividend yield down to 4%, we'd still be a little bit more than double the S&P 500 dividend average. And it's, nobody could complain about that, and they'll try to conserve cash. I don't think that would be particularly good for the stock, but the real problem is, and this is why I think this is such an important topic, dividend investing, because if you're the baby boomers, retirees, soon to be retirees, that is the population that really looks to passive income, because they're thinking they want passive income to replace their job, to replace their active income when they retire. So a lot of people take a look at a stock like an AT&T, and there are many other examples, and they say, wow, that's a great dividend yield. I need to own that stock because of the dividend yield. But, and they say things, oh, but it has a great yield. It's got a 5% dividend yield. It has a 4% dividend yield. That's AT&T. And then the stock went down. Then it had a 5.5%. And the stock went down. Then 6%. Stock went down. Now it's almost a 7% dividend yield. Maybe soon they'll be saying it's a 10% dividend yield because the stock keeps going down. And what I say to these people is, the company pays about $2 a share, 204, but let's round it to $2 a share. If the stock goes from 30 some odd dollars a share to 29, you lose over a third of your assets that you have in AT&T. Stock's down 10, 11, $12. But big whoop, you have to wait an entire year to get the $2 dividend yield. And that's what happens when people chase yield. And I've seen this. Look, I've been doing what I do now for 30 years. And I've always seen retirees and soon-to-be retirees make the same mistake in every cycle. They do something called chasing dividend yield. So they buy high-yield stocks, and they think they're doing something smart. I mean, I keep my clients out of this stuff. I warn them, and I diversify their sources of passive income between bonds and stocks and different kinds of stocks. Okay, so just diversification. It's a strategy that we all use I use to reduce risk, but it doesn't necessarily prevent your portfolio from going down. Obviously, in a generally down market, but we do want to diversify our income sources, just like we want to diversify our investments in general. We don't want one rotten egg to spoil the whole basket. We don't want to be taken down with one investment. So there's a few things about investing in dividends. So let's talk about dividend ETFs, because this is where a great many people invest for dividend income. There are basically two kinds of dividend ETFs, exchange traded funds. So first, real quick, does everyone know what an exchange traded fund is? We hear that all the time, but there's two parts to the words exchange traded funds. Yes, I know it's three words, but there's two parts. The first part is exchange traded. So exchange traded funds, ETFs, are traded on the New York Stock Exchange or the NASDAQ, but they're traded just like any other security. You could buy them or sell them at a moment's notice. And then the other part, the last part of the exchange traded fund is a fund, because these are funds of different types of securities that are put into a neat and tidy package to make investing and diversification much simpler. And I happen to think it's one of the greatest innovations ever in investment history. Now, it might not sound like, ETF, what kind of big deal? That's no great innovation. That's nothing special. We've had those for years. But at the time, late 90s, when ETFs started coming out, and early 2000s, it was a big deal. And it was a very unique way to invest at the time. And, they were going up, the ETF industry was a tiny little industry, nascent industry, going up against the Goliath of the industry, which is the mutual fund industry. Well, now ETFs have basically conquered the mutual fund industry. It's people have been moving money from mutual funds to exchange traded funds for years, and I don't see any sign of that slowing. There are a lot of advantages to exchange traded funds. They're easy to trade. You can put limit orders on them. They're often tax efficient. So there are some really good advantages of exchange traded funds. But the biggest innovation I see for exchange traded funds, just from a personal point of view, is that investors now have the ability to invest anywhere in anything at any time. I mean, there are ETFs that follow the price of copper, that follow the price of gold. There are ETFs for international markets, for just individual countries like Mexico and China and Canada, and there are in Japan, and there are exchange traded funds that allow you to invest in different kinds of fixed income assets like high yield bonds, aka junk bonds, and treasuries, and buying sovereign bonds of foreign governments. There's an ETF literally for almost anything that you want. There are ETFs for investing in companies in robotics and artificial intelligence and clean energy. So that's a just to give you an idea of how splintered and how fragmented the exchange traded fund industry is and how big it's gotten. But there are basically two kinds of strategies to invest in an ETF for dividend investing, dividend stocks. There are those that are high yield dividends, and that's a nice name, high yield dividend. High dividend yields are a terrific thing because, the more dividend yield you get, the more money you get, the more passive income you have. Who doesn't want that? There's a drawback to that. And then there are dividends, ETFs that focus on companies that don't necessarily pay the biggest dividends, but have shown the ability to grow their dividend yields consistently over many years. So that's called usually called Dividend Achievers Index, dividend growth investing. And we need to compare the two because for the last 10 years, people have really enjoyed the former one, the higher dividend yielding type exchange traded funds, but they're paying a pretty steep price for that joy now with a pretty steep loss. And although dividend growth ETFs are holding up better, they're down too. But my sense is there's a good chance for those to recover quicker. And I want to give you an example. And this is a real life example based on the 4 o'clock close today. So we're going to do a really good screen share right now. All right. And this is going to be really good. And I'm really pleased with how this is going, by the way. Okay, so let me put this up on the screen. Now you see this chart here? This is comparing I'm using two very popular exchange traded funds in the dividend space. They're both from Vanguard. They're very popular. One is the symbol is VIG for dividend growth investing. And that one is the one here that's down 10% year to date. VIG is down 10% year to date. Now its dividend yield is 1.87%, which is very, very close to the overall S&P 500. Its expense ratio is only 6/100%. So it's a tiny, tiny little expense ratio. The one that's down negative 19, that's the VYM is a symbol. That's Vanguard's high yield dividend ETF. And that one's down 19%. So you see the difference by getting a little aggressive on trying to get more dividend yield. That one right now pays a 4.45% dividend yield, so more than double the dividend yield of this one that's down 10%. But look what's happening. They're down, investors in that are down almost 20% on their money in the portfolio. So even though you're getting 4.4% now, 4.45%, you're doing that. It's actually more risk by going for the higher dividend yield because the kind of companies that pay higher or fat, let's say juicy dividend yields are often the companies that don't have the same growth opportunities or growth markets that other companies have. So they don't really have much to do with their money, and they're often just defending the market share that they have, or they're not reinvesting in their business and saving that money so that they can buy a different company that could help kickstart their growth. And then you see the negative 12%. I don't know if you could see how well you could see that. I'll make this a little bigger. Okay, I'll make this a lot bigger. All right, this should help you see this a lot better. So if you take a look at the negative 12, that's the S&P 500. So dividend growth investing has outperformed the S&P 500 by a little bit. And I like this particular way better in terms of dividend investing. And, that's my own preference. And the one, again, that with the high yield dividend investing is down 19%. So that just goes to show you where the money is going. So let me just stop sharing the screen there and get back to you. By the way, the Vanguard, the two Vanguard ETFs I showed you, they both have a dividend. They both have an expense ratio of 0.06%. So since the expense ratio is very low and the same, you really can't explain any of that, the two ETFs, the difference based on expense ratio. So that's what I want to explain to you about this. So if you're a retiree and you're chasing after higher dividend yields and you're really looking to get paid as much passive income as you can on your investments, think of it like this: too much of a good thing is not a good thing. I'm going to see who's out there in the world. We've got a couple of people out there. Bill, it's great to see you. Thank you so much for being out there. Judy, love you too. I got a heart from Judy, who's like, Judy is like right there and sitting on the couch because I'm broadcasting from my den because, working from home. So she's about 6 or 7 feet away, but we're not social distancing. This just happens to be the location of the couch. Got a couple of comments out here. Good afternoon, Bill. Thank you. Very nice to see you. And good afternoon to you, John. I'm here, teacher. Yeah, thank you very much. I like that, being being the professor. It's a role that I relish. Hey, I use relish. You see that, John? You're in the food. You're a foodie. You're in the food business, and I use the word relish. I'll just take a look to see if anybody's out there in LinkedIn land, and then we'll get going, and I'll wrap this up very, very quickly. Okay, so out there in the land of LinkedIn, we've got a few people out there. Hey, Brian, good to see you. Are there any industries that you feel offer more secure dividends than others in this current economy? Yes. If you look at the industries right now that are doing well, consumer staples, companies like, that sell things that you need as opposed to things you want. So in consumer staples, I mentioned to you, Procter & Gamble, for example, raised their dividend. Costco raised its dividend, and healthcare, Johnson & Johnson. So healthcare, consumer staples, those sectors typically hold up better in terms of their earnings and revenue performance in a recession. So they're more likely to maintain dividend yield and even grow their dividends a little bit in a tough environment. So that's the answer to that. And then you take a look at cyclical companies like consumer discretion. Those are the companies that make things you want, not that you need. You take a look at industrials, energy. Those are the types of companies that suffer typically the most in a recession. So they're most likely to have to suspend or reduce their dividend yields in order to preserve cash. All right, everybody. This was a great session. I'm really happy you guys are all out here, and I hope you got a lot out of this. I'm going to end this broadcast, and I'll see you soon. Thank you.